Do you want to understand liquidity like no one else? If you understand it and learn to use it, you will stop being the prey and become the hunter. Liquidity in the Forex market is the ability to quickly and efficiently buy or sell a currency pair without significantly affecting the price. Daily trading volume on the Forex market exceeds $7 trillion, with the main liquidity providers being large commercial and investment banks, 50 to 60% of the market. Hedge funds and institutional investors, 20 to 25% of the market. Central banks and state institutions, 5 to 10% of the market. Retail traders, through brokers, 5 to 8% of the market. Why are retail traders not shaping the Forex market? 95% of liquidity is managed by large players. Retail traders are rather passive fuel for the movements of large institutions. Retail liquidity is important for big players. It is used to execute large orders and manipulate the market. Successful traders do not behave like retail. In order to survive, a retail trader must think like an institution, understand order flow, and monitor market liquidity. How do we identify liquidity? With our technical tool, BOS Trader, you will get a clear overview of where the real liquidity is. We focus on the key areas where this significant liquidity is located. We wait until the price reaches this liquidity. With our special strategy, we have extra confirmation. After significant liquidity grab, we monitor whether the price is in the volume zone. We identify these zones using the value zone's technical tool. If the price is in the area of our volume zone, we are waiting for the creation of an AOI zone. We target strong liquidity points that the market has left behind. And as we can see, the market really came for these points. And we have several such examples. Do you still believe that market makers are following your stop loss? In that case, you are watching the right video, because we can prove to you that it is not true. Banks and large institutions trade in volumes of hundreds of millions to billions of dollars. As a rule, retail traders trade in lots from 0.01 to 10 lots, which is practically ridiculously small money for institutions. Proof. If banks were really hunting for retail stop losses, it wouldn't be worthwhile for them, because the volumes of retail stop loss orders are too small to have a significant impact on market liquidity. Institutions and algorithmic trading institutions use algorithms that recognize retail behavior, for example, group purchases before major news events. They create high liquidity in areas where they expect large price movements, whether due to retail traders or macroeconomic events. The psychology of institutions is based on the precise search for liquidity, not on the manipulation of retail stop losses. Institutions focus on understanding market sentiment and optimizing inputs and outputs. In the next example, we can see how the market behaves in relation to liquidity. Price accumulates significant liquidity and reacts to key volume levels. BOS Trader will show you where to enter the market. We will target our loaded significant liquidity. As you can see, liquidity is a very strong market factor. Follow our social networks where we post every day how our tools work on the market. Do you want to become a part of Influxum traders? Write Influxum in the comments and we will send you a link.